This chapter we get into long-term debt, so that's normally bonds or notes payable. So again, normally it's a way for companies to acquire money. They either can get it through debt or equity financing. So first we're going to start with this chapter talking about debt. And we will have to do the present value in some of these computations as we go through to value the debt at today's value. So we start with bonds. Bonds are, again, a way for corporations to borrow money directly from investors. So they can go into bond funds where people buy, or they could sell them again directly to a person like you and I who wants to invest. So you want to know the terminology. The face value or the face amount of the bond is the par value or the principal or the stated amount. It's also the maturity value because it's what they'll pay back at the end. It's what they're legally obligated to pay back. They will pay a stated rate of interest, or it could be called a coupon rate of interest or the nominal rate of interest. So you got to get used to those terms because they all mean the same thing. But that's what the bonds pay over the life of the bond, and it never changes no matter what happens with the market rate of interest. The bond indenture is basically like the legal contract that governs those bonds. And if a company would fail to live up to those terms, then those bonds could be due and payable. That trustee who holds it could bring legal action to that company and make them pay those bonds whatever's due right then because they violated that agreement. Whoops, too far. So debenture bonds are backed by the company as a whole. So there's not specific assets like that are backing these bonds, but basically just the company as a whole is going to be saying that, you know what I mean, that these bonds are good. Mortgage bonds are going to be backed by a specific real estate. And then again, because you've got more collateral, normally the interest rate's a little bit lower because, again, there's going to be a little less risk in those bonds. Then we have a variety of different types of bonds. So callable bonds means that the company can call them back prior to maturity if they choose to. Normally, the call price is an amount that exceeds the face value because the investors obviously want to make some money, so they don't want to give you $10,000 and then you immediately call it back at $10,000. They made nothing on their investment. So normally that call price is a little bit higher. And again, it also depends on how far into the bonds they call it back. Sometimes bonds, especially if they're like local government type bonds, they're going to be set up with the sinking fund redemption so that, like, let's say they're 10-year bonds. Every year, 10% of those bonds need to be called in or retired. So a lot of times it'll be just random or based on, like, you know, serial numbers of those bonds, but they will call those in. So by the time they get to year 10, they will have called in all the bonds and they'll be paid off. So I guess those are the sinking fund, but the serial bonds are when they are retired in installments. So then, like, you know, you'll know after 2 years, this group of bonds will be retired. 4 years, this group of bonds. So again, it's just another way to get it. So each bond in that offering has a specified maturity date, and I think it just helps the companies get them paid off. Then we've got convertible bonds, and those are at the discretion of the bondholder. Instead of getting cash, they could get shares of common stock. So if bonds are issued just at their face value, obviously those are easiest. So we've got these $700,000 bonds that pay 12% interest, and it's semi-annually. So 700,000 times the 12% divided by 2 is where that $42,000 comes in. If they're sold at face amount, then you get cash for $700,000 and set up the bonds payable at $700,000. So then we want to think about face amount. When that happens, it's because the rate that the bonds are paying exactly equals the market rate. So then there's no reason to pay more or less for those bonds. if it's the other direction, so like let's say the bonds are paying 12% and market is higher than that. So when we say market is higher than that, we mean other bonds of a similar nature, you could invest in them and you could get 14%. So nobody's going to want those bonds, right? If I have $1,000 to invest, I want 14%. I don't want 12%. So then the price has to go down. So then they sell at a discount and then you'll get investors to buy them. Or the flip flop could be true. The market, other bonds on the market could be paying 10%. Your bonds are paying 12. Everybody's going to want your bonds. So then the price is going to go up. They're going to sell it a little bit higher than the $1,000. So again, the premium is when we sell for more. The discount is when we sell for less. Face value is when we sell at the exact amount. So bonds are rated. You could go to, like it says here, Moody's or SP ratings, or the different publishing groups will give you ratings of those bonds. So like a AAA bond is the best bond. When you get down here in these C and D bonds, those are going to be the worst bonds. Or when I say worst, I mean the most risky. Doesn't mean you couldn't make money on them, but the risk is higher. Okay, so then our bond price, normally when I do a bond problem, I'm going to use my time value of money keys on my financial calculator or the time value money keys in Excel. So then what you do is you compute the present value. So the values that go in there is the future value is the face value. What it is paying in interest is your payment. The IY is the market rate of interest, and then your N is how many interest payments there are, and then you compute the present value. So the textbook likes to use the tables though, so that's probably what they'll show us in here. So again, I would recommend using the calculator because again, they show you these are basically the numbers that would go into the calculator. Your N would be 6. Your IY is 7. Your future value is going to be the 700,000, and then you compute the present value, and then you get that same answer. So again, do it in Excel, do it in the time value money keys on a financial calculator. But then once we have that total, then our again, they're just showing you how you bring it back. Again, I'd rather just use a calculator. Okay, once we have it though, then our journal entry, we're going to show the cash coming in at that calculated present value price. Then we're going to show the liability because again, they owe the $700,000 back in the future. That is the liability of those bonds. So that's our credit. Then the difference goes to the discount. And then we already did when we did chapter 12, we talked about bond investments. So now they're going to show you that. So the investment in bonds is at that face value. They have a discount on the investment of bonds, and then they pay cash. So again, we can kind of now relate to both sides of that transaction. And then again, if you can remember back from that chapter, they use the effective interest rate method. And this one will show you straight line as well. But if we use the effective interest rate method, let me get to, do they show us the table? I think they eventually show us the table. But so what they're showing us here is after when we're making our first payment, notice the cash is the $42,000. So that's what we calculated at the beginning. It's the 700,000 times the 12% divided by 2. Or was it times 6%? I forget. Let me go back. Yeah, 12% divided by 2. And this is the market rate is 14% divided by 2. Okay. So then again, that's how that 42,000 is calculated. Then the discount is going to be what we amortize. So we take our value of the outstanding balance and we multiply that by the effective rate or the market rate of 7% for 6 months. And then that gives us the amount that we're going to discount it. And then the interest expense is going to be those two added together. And then we see what the investor is booking because they're paying the cash and they're going to have the interest income. And then they're also going to be amortizing the discount, but on their investment. So this is what I wanted to get to, I think, was the whole schedule. So again, the cash is what the company pays, same amount every 6 months. Because our balance is changing here, you can see it's increasing to get up to the 700,000, then our interest is going to be calculated on that balance. So then not the interest, but yeah, the effective interest, I guess. So the effective interest is calculated on that balance at the market rate, and then our difference between the two is how we amortize out that discount. Now you can have zero coupon bonds where they are just sold at a very deep discount, and then so say they sell them at like $450, and after 10 years you get $1,000 back. So they pay you no interest. If you get your $1,000 back at the end, then you are going to make money on that deal. Okay, then bonds could also be sold at a premium. So if the market rate goes the other way, to say your bonds are paying more than similar bonds in the market, then people will pay extra. So again, they show you the tables. I'm going to go to the next slide. I would do it on the financial calculator. And again, your same thing as what we did with the first one. Your N is going to be your number of payments. Your IY is the market rate. Your payment is the 42,000. The future value is the 700,000, and then you compute the present value. So again, in this case, the market rate was 10, but we're doing it semi-annually, so that would be 5. And then you would compute the present value of that, and you would get this 735,533. So that's the cash that comes in. We still only have a $700,000 liability, but now we have a premium. And again, they're showing you what the investor would book on their books. So here's the amortization of that premium. Same thing though, we're taking now the 10% though, instead of, so 10% a year, 5% a semi-annual period, and we're amortizing that out of the premium, so that when we get to the end of the bonds, we still only owe the 700,000. Oops, come back. What was that saying? So that kind of shows you again the face value of the payment at the 6%. Again, 12% a year divided by 2. The outstanding balance, so the 5%, which is half of the market rate, times the outstanding balance gives us the effective interest. The difference between those is what we're going to reduce our premium by, and then the balance just keeps going down. And then here we see that whether we sell it at a premium or we sell it at a discount, as we amortize out those either premiums or discounts, both of them end at the 700,000, which is what they're legally required to pay the bondholders at the end. If the bonds or if the financial statements are prepared in between interest dates, so say they pay interest on January, so it's payable on June 30th and December 31st. But so say our year-end date is October 31st, and we need to adjust those. Obviously, we're not going to record the whole 6 months. So we're just going to base it on however many months we are into the bonds. So in this case, we're 4 months in. So we're going to just take 4/6 of the interest, 4/6 of the amortization, set up that payable. Then when we go the other direction to get to so now we're on the last 2 months. Again, we would do the remaining 2 months then to get to the end of December. Straight line makes it easier than doing that whole amortization. So what you do is you take the discount. So the discount was $33,367, and you just divide it by the number of payments left, and that's your amortization for each 6-month interest payment. So then it'll be so these entries will be the same. It doesn't matter what payment we're on. So then you can see the amortization table and how it's calculated, but then you can see it's the exact same amount. So that's the easiest way to do it. Possibly not the most accurate. The effective interest rate is probably a little more accurate, but again, this is a lot easier. We can also have debt issuance costs when we issue out these bonds, and those are also going to be amortized out to expense over the life of the bond. Okay, then our next category of liabilities is our notes. So we can have long-term notes payable where we're borrowing money, and again, like we could have it on the other side where we're the notes receivable, but now we're on the payable side. So if we go borrow $700,000 in cash, we receive the cash in, we set up that long-term liability, and we're going to pay interest of $42,000. So it's that same rate, that 12%, but we pay it semi-annually. So then we're going to pay the interest of $42,000 to the bank First Corp, and then we're going to debit interest expense. And then that would be what we would pay every 6 months. And then we'd owe the whole $700,000 back at the end. And then that's what this slide here shows. Then once we get to the maturity date, we're going to credit cash for $700,000 and then debit that notes payable to pay it off. We could also issue notes in exchange for assets. So say we're purchasing a machine and then we're taking out a loan for that machine. So again, what they're having us do is calculate the present value of this. So like if it wasn't stated, like if we said, okay, we're buying this labeling machine and it's a 3-year note. At the end of the 3 years, we're paying $700,000. So we're not going to value the machine at the $700,000 because that's a future value. We've got to bring it back to a present value. And then we've got to factor in that we are paying interest semi-annually. So again, it's the same computation. I would use, again, Excel or the financial calculators to get to that present value. But then that's what we would record it at, is at that present value amount. Okay. So here we've got the recording of the notes payable, what we owe them back at the end, the value of the machinery at the cash price, and then we have a discount because of the interest rates are really the 14% versus the 12% that we're paying. So it's very similar though to what we did with the bonds. It's just a notes payable instead of a bonds payable, but we still pay the $42,000, the stated rate times the face amount. We're still charging interest expense at the market rate, and then our difference is the amortizing of that discount. So again, the schedule should look the same as what we just saw in the bonds. It's just a different, again, it's just a note instead of a bond. Now then we can have it set up, which is normally, like say we're going to get a car loan or a mortgage loan. It's going to be set up so we pay an equal payment every month for a period of years. So when we have those, I also like to use my time value money keys on my calculator to do those as well. So if you know you've got the $700,000, that's how much we're borrowing today. At a 3-year note that is paid semi-annually, that would be 6 semi-annual payments. And then our interest rate is is it going to be the 14% though again? Yeah, so the 14% we're assuming is our interest rate. But then again, divided by 2 because it's semi-annually. And then we would calculate, though, instead of calculating the present value, we would calculate the payment. So then we should get this cash payment amount that effectively is going to kind of amortize out the payment to reduce the outstanding balance, as well as charge interest expense. So this column represents our interest expense. This represents our decline in the loan amount, and then we see the loan amount going down. Now, if you're using the financial calculator, there's an amortization function where you can do one payment at a time to see what, so your P1 would equal 1, your P2 would equal 1, and it would show you out of this payment, this much is charged interest and that much reduces the value. Excel would do the same thing. So Excel has that same function. So when we first set it up, we record the asset coming in and create the liability. And then as we pay it, we're going to charge interest expense, reduce the liability, and then credit cash. And then the cash is always going to be the same amount. The interest expense and the notes payable will shift depending on what payment we're on. And then you can see the seller does the same thing. So businesses always have to look at, there's risk involved when we borrow money, but if we're able to use that money to make money, then there's benefits to be had. So again, a lot of companies do go into debt so that they can make money, and as long as they're covering the cost, the interest costs, and the cost to issue the debt, they're going to be okay. We have different ratios that we calculate to look at their level of debt. So the debt to equity ratio is the total liabilities, which would be current and long-term, divided by their shareholders' equity. Again, we've got the higher the ratio, the more risky the company is, or the more risk they're willing to assume. Maybe if we looked at their financial statements, they might be a stronger company. You don't know. Just because they're assuming risk doesn't necessarily mean that they're bad. Then we have our return on assets, so net income divided by our assets. So how our assets are making us money. And again, you'd like that to be higher than the interest rates. Our return on equity is how we are using our stockholders' equity to make money. And again, the higher the better on that. And then our times interest earned is our net income plus our interest expense plus our income taxes divided by our interest expense. So that too, the higher the number, the better. The higher the number, the more cushion you have. So in this case, Coke would be better. They could pay their debt, but it's also because Pepsi was a little bit more risky. They had more debt than equity. So it would stand to reason that Coke's times interest earned ratio would be higher. Debt can be retired prior to maturity date. And again, that would be like if your interest rates were really going down and the company saw an advantage to paying off their debt now and maybe just reissuing it at a lower rate. So they're going to call their bonds at that call price. So again, you can see it's a little bit higher than the book value. So the investors get a little bit more money, but then the company has a little bit of a loss. Again, the call price less the book value. And then we're going to take those bonds off of the book. So whatever was left in the discount would come off against our bonds payable. And the reason the company would do it is if interest rates were going down and they could reissue them at a lower rate or maybe get a loan at a lower rate. Bonds that are convertible into shares of stock, again, that can be like a lucrative thing for the bondholder, and they may choose to do that. So when it happens, though, we would, so in this case, we're issuing the bonds. So we're issuing $1,000 bonds at a premium of 103. So we get $103 in millions, though. So we get 103 million. We issue those bonds payable out at their face value, and we have the premium. Then when they get converted, if they choose to issue, if the bondholder chooses to get the common stock, we're going to take the bonds out of our bonds payable, take the premium out, and then record that total into our common stock because we are issuing them shares of common stock instead of their debt. Okay. And then this would be on the other side of it, right? So this is the person who holds the investment. So they're getting now an investment in common stock, taking it out of their investment in the convertible bonds. There can be times when we are kind of pushing the bondholders into converting those bonds. So if there's a call provision, or we just encourage them to voluntarily do it, because again, maybe there's a better ratio for them to do it, and they'd end up better in the long run. We can also have detachable stock purchase warrants. So it gives the investor normally pays for this option, but it's the option to buy the stock at a specified option price within a period of time. So the investor would have to expect the stock price to go up. So they're willing to pay to kind of lock in at that price. So if we have bonds that are sold with those detachable warrants, so we're going to receive so for each warrant permitted, the holder to buy one share of no par common stock for $25, but these warrants are going along with the bond. And then shortly after issuance, there is a $3 exchange for those warrants. So if we look down here, what they have in the red, they're saying, okay, each bond came with 20 warrants, and then we're gonna. So these are in the 100,000s though, so you could almost cross off the extra zeros there. But so then the 20 warrants times the $3 are what is coming in with these 100. I see, because this is in millions and these are in thousands, but each bond is $1,000, so that's why we've got the extra 3 zeros in there. So again, the 20 warrants times the $3 is how we're going to value those. And then notice they go into the equity account, or the equity part of our balance sheet, as stock warrants. And then as those bondholders would then exercise them, they have to pay the $25. That's the price that the option is for. So then we're going to have $25 coming in cash. We're going to get rid of those 3 stock warrants, and then we're going to give them shares of common stock. So we take the stock warrants off the books and we issue them shares of stock then for the difference.